Today's show may give you some comfort in some uncomfortable times.
We need to become comfortable that the Fed is going to be hands off from here on out. And in fact, to throw a real wrench into things, I think the Fed could consider waiving rates at some point early next year if we continue to see inflation be this persistent and act as a debilitating element to the baskets of stocks that we're all holding, and that in conjunction with tariffs.
That's Andy Wells, Chief Investment Officer at Sanjac Alpha. And he's talking about how you need to get comfortable with the idea that the Fed's not cutting rates probably this year, and with the idea that the bond market is presenting a true picture of what's happening. He's our big interview. But up first, Todd Rosenbluth, head of research at VettaFi, wants you to get comfortable with his ETF for the week, an international fund, at a time when some people think international might be starting to fade a little bit. Plus, we've got Ted Rossman from Bankrate.com, who's talking about just how uncomfortable people have gotten with today's tipping culture and ways that you might get a little more comfortable with it. And I will answer a listener's question about investing in Bitcoin, which they find uncomfortable too.
Hello.
Hello indeed, and welcome to Money Life for June the 5th. I'm your host, Chuck Jaffe. Thank you so much for being here. We have a great show planned and executed, and I'm going to let us get to the talk as quickly as I can because I want to take a little extra time answering the question, and I definitely wanted to take extra time with Ted Rossman talking about tipping, which is always a fun subject. It just is stunning to me what you wind up seeing, and people complain about tipping, yet they do tip to some extent. The Gen Z numbers are really alarming, like Gen Z not tipping, and understand where you should tip. Ted's going to make a point about there are places where, as part of the social contract, you should be tipping, and then there are things where no, totally optional, don't worry about it, etc. And yet I think it's hard for people to wrap their heads around it sometimes. And again, when I started taking over the lacrosse league and we got our credit card reader and it came set up to have a tip screen, yeah, I wouldn't expect anybody to tip me. That's not the kind of thing it is. And yet it would have shown up on every credit card transaction if we hadn't figured out how to get it out of there. So I know that tipping culture is part what we make of it. It's also changing a lot. So that's a really interesting discussion. Todd Rosenbluth is here with an international fund. Andy Wells will tell you later that he thinks that domestic, even though the gains may be slight, like 5%-ish or what have you, he says that he thinks international may have run a lot of its course, which would agree with Alan McKnight from earlier this week, but disagree from Brad Lamensdorf from earlier this week, right? We've had this whole thing about has international run its course. So make sure you're tuning into that as well. Write me, Chuck at MoneyLifeShow.com. I'd love to hear from you. But right now, let's just jump straight in. Todd Rosenbluth, one of your questions answered. Ted Rossman and Andy Wells. It's a great day to live the money life, and the proof starts in a moment.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
One fund, on point for today, the experts to talk about it. Welcome to the ETF of the week. Yes, this is the ETF of the week, where we examine trending, new, newsworthy, unique, and intriguing exchange-traded funds with Todd Rosenbluth, head of research at VettaFi. And if you go to VettaFi.com, you'll find all the tools you need to improve yourself as an ETF investor. Todd Rosenbluth, great to chat with you again.
It's great to be back.
Your ETF of the week is
the Fidelity Enhanced International ETF, FENI.
FENI, Fidelity Enhanced International. So international has been doing great, but what are the enhancements here that make you particularly interested in this fund right now?
You're right, Chuck. So Fidelity's fund is actually outperforming the traditional index-based products, the EFA-based strategies that are out there in 2025. It's a couple hundred basis points stronger. That caught our eye. How is it doing so? This is a relatively low-cost active ETF that the enhancements is more of a quantitative strategic approach to investing. So it's got a broad approach to the overall strategy. It's going to benefit from the selection of individual stocks, and it's working quite well. And what we've seen is that investors have been gravitating towards this. The investors have largely sat out the international equity rally for much of 2025, but we've seen in the past month this ETF from Fidelity, FENI, or FENI, as I want to call it, FENI has really seen strong interest.
Fidelity, on its ETF side of things, has been one of those companies that's been moving its active traditional fund strategies over to ETFs. So is that what they have done with this, or is this a fund, because it's got an established track record, it's been around for a while, that has been standing on its own 2 feet without a classic fund tied to it?
This is one of those funds that I believe launched as an ETF, but you're right. They have been moving some mutual funds to ETFs, and they've been building out their lineup. They're right now the 6th largest of the active ETF providers. They have a goal to be a top 3 provider, and it's funds like this Fidelity International ETF that I think is going to help them get there. Advisors and investors are increasingly turning to active ETFs. Active ETFs are roughly 40% of the net inflows in 2025, despite being roughly 10% of the overall asset base. And you get low cost benefits of diversification, but the security selection, and you're getting companies that you wouldn't have within your US equity exposure. So Sony, for example, the Japanese company, is one of the top 10 holdings that you find within this Fidelity ETF, obviously not based within the S&P 500.
I want to go back on something that you said, because you said you're getting low cost exposure. So FENI, since we'll call it by what you want to call it by, FENI, the Fidelity Enhanced International ETF, has an expense ratio of 0.29%. An index fund is going to be less than half of that if you're buying the leading index funds that are tracking the EFI. But as you pointed out, the performance is better in this fund. And oh, by the way, when we're talking performance, it's net of expenses. So if you look at 2 funds, you go, well, this one's more expensive, but it's had better performance. It has more than overcome the hurdle. So not worried at all, or 0.29 is cheap enough that it would be very different if we were talking, double that level or something like that.
You're right. And I just want to use my words. What we find for low cost index based products are you can get 10 basis points or so, 10, 15 basis points to get broad index based exposure to international equities. International equity investing on the active side tends to be more expensive, because to do that fundamental analysis and look through companies from the United States, you might need to have on the ground resources and do some meetings in person. So 29 basis points kind of splits the middle. Fidelity is aimed to do that, to use their scale as an advantage for this enhanced suite. So I think 29 basis points is a reasonable fee to be paying for active management in a more strategic manner. And yes, you're right. The fees are included in that performance. You said FENI, I'm saying FENI. I guess we can split the difference there too.
Might just be tomato and tomato when we look at that stuff. But what's not tomato and tomato is this is the ETF of the week. And although you don't make market calls, I find it a particularly interesting time to do this, because I had a guest on Money Life this week who was talking about how international has clearly been the leading place this year, but he doesn't expect it's going to be the leading place for the rest of this year. Now, you're not making a market call. That's not what we're trying to do. But when you're talking about, hey, look at a fund like this now, how much do you have to warn people that, this has been quite a party, but it's been going on for a little while?
So I'm intrigued by your guest, who I guess another way of phrasing that is he was wrong for the first 5 months of the year, thinking that the U.S. equity market is going to outperform international investing. I'm not necessarily saying that is or is not going to be the case, but I think it's hard to see the strength that we're seeing investing in Europe and Asia and the developed markets in particular, and ignore it. And so if you were underexposed to international equities strategies coming into the year, you're even more underexposed to it, because international equities, you're missing out on it. So we think investors should take a closer look at international equity ETFs. We've talked about a handful of them in the last few months. some that are actively managed, some that are indexed, some that do much more fundamental security selection than what we're seeing here with the Fidelity product. There's lots of good choices for you to consider, but you probably have less exposure to the international equity markets than you might realize, and you're being penalized for it. If it continues, you want to have exposure.
In defense of that strategist, he was not wrong thus far this year. He entered this year saying international would beat domestic and to be fully diversified. It's what he sees for the next 6 months that's going to be interesting. That's where we have to see whether or not the rubber hits the road on this one.
So disclosure, fully appreciate that. For investors who want to, obviously you should be looking forward with an investment strategy, not backward. If you think that the international equity markets are going to do as well, if not better, than the US in the next 6+ months of the year, FENI is a great strategy to get exposure. Active management in a low-cost manner can fill in very nicely with either a traditional index-based product and give you a little bit of active tilt, or if you have an active manager, to reduce some of that benchmark risk.
How well does this fund play with others and mix with others for somebody who has, we've been saying you don't have enough international exposure. It's a message we've said a bunch of times this year. But if somebody's gone out, whether they had it before or they've bought some of the funds we've talked about previously, do they add this to a portfolio? Does it bring enough uniqueness? Or is this like, this is your core international holding? If you don't have enough, this is one of one or two that you want to have there.
So I think the same way in the US, you probably have a couple of different strategies to balance that out in terms of at the cap level and the style level and diversification. I think internationally, it's prudent to have probably a pair of international equity strategies. So how this could play well if you had a low-cost index-based product, you're getting some active management, you're getting some differentiation. I can't look at side by side at the individual holdings and look at the camera at the same time. But if I did, I'd be able to see there are differences in the top 10 holdings of the Fidelity Fund and IEFA, which is an iShares low-cost index-based product. So this could pair well with IEFA. If you had I think we might have talked about a more concentrated international equity ETF beforehand. This could also, you get active management, but you're getting that risk spread around through more securities. The largest position is roughly 2% of the portfolio. So this can play well with other ETFs.
It's FENI or FENI, but any way you pronounce the ticker symbol, it's Fidelity Enhanced International, the ETF of the week from Todd Rosenbluth. Todd, look forward to chatting with you again next week.
Have a good week, Chuck.
Todd Rosenbluth is head of research at Vetify. Go to vetify.com for more information and to use their tools to make yourself a better ETF investor. And of course, Todd starts us off every Thursday, and we are just getting started on this edition of Money Life. Next, I will answer a listener's question. Then, Ted Rossman from Bankrate.com on their latest survey about tipping culture. Are you a little fed up with tipping? You might be. It'll talk all about that. And then Andy Wells from Sanjac Alpha in the big interview. This is Money Life.
Asset managers, you know how hard it is to stand out in this crowded space. Vetify is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, Vetify can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at vetify.com.
We'd like your help on this, Chuck.
Oh, will you help me? Can you help me?
Help me, Obi-Wan Kenobi.
We need your help, Chuck.
Help you, I can. Yes.
Well, I'd like to think I can help you when it comes to answering questions, and I love getting your questions. And while I may not be Yoda-ish in terms of certainly not size, but also in terms of philosophies, I love being able to provide help when it comes to answering your questions. You just have to send them to me.
I'm sorry, but all questions must be submitted in writing.
Chuck at moneylifeshow.com is how you do it. And by the way, I've gotten a couple of questions about hedging, and specifically about hedging currencies. And I'm bringing in an expert to talk about that at some point. So if you have questions on that specific subject, now would be a great time to get them in, because we know we're bringing in someone to answer those. But any questions you've got, if I cannot answer them myself, I will find someone to help answer. Now, today's question comes from Al in Boston. And I'm wondering if he used to live someplace else because, well, I'll explain. He writes, Chuck, I used to listen to your show when you were on the radio in Boston. I only found your show a few weeks ago. I wish I had known you were doing this all this time. Mind you, it's been more than 20 years since I was on live radio in Boston, but I'm wondering if he was Alan Malden. Had he asked me about Texas Instruments, I would have known for sure, because Alan Malden used to call us all the time asking every guest about Texas Instruments. But that's not what he's asking about this time. He writes, I have a question about Bitcoin funds for you. I think it's time to put one in my portfolio with a little bit of money, kind of the way gold should be in a portfolio. That's how I'm thinking of crypto. But is there anything I should know about picking a Bitcoin fund, or are they like gold funds where every fund is basically the same, so just pick the cheapest one? Well, Al, great to hear from you. Sorry you're 20 years since you heard me last until recently or what have you, and that you're basically 13 years late to the party. We have been calling Money Life as a daily weekday podcast since 2012, but happy to answer your question. And first things first, let's just clear it up. On gold funds, I wouldn't say they're all the same. It's spot gold funds are basically holding gold, but you've got miners and you've got any sort of precious metals fund that might have a mix of assets or that would own gold miners, etc. And you can have the same thing when it comes to cryptocurrency funds. In fact, there was recently an article in U.S. News and World Report that was headlined, the 7 best cryptocurrency ETFs to buy now. But if you were looking for a spot cryptocurrency fund, there was only one of the 7. Everything else was blockchain and technology, or it was some sort of a blockchain futures or a Bitcoin futures fund, or it was a covered call strategy. So they're not all created the same. And it sounds like what you want is a spot Bitcoin fund. Now, a spot Bitcoin fund is one that effectively pulls all the money together and buys Bitcoin, right? Buys Bitcoin directly. A Bitcoin ETF is going to be managed by an investment firm. It's going to be listed on a traditional stock exchange. It avoids the problem of trading cryptocurrencies directly through a crypto exchange, which can be complicated and what have you. So what happened was they introduced ETFs tied to Bitcoin. That occurred in 2024, and it's a lot easier to do this now. But there is a distinct difference. There is a spot Bitcoin fund versus a Bitcoin future fund, and a Bitcoin futures fund was all that was available prior to 2024, right? A Bitcoin futures ETF provides exposure to the price movement of Bitcoin futures contracts, much more volatile, much less tracking the value of an asset day by day. If you are wondering whether or not you should be buying a Bitcoin ETF, which apparently, Al, you've made the decision you want to do it, no, it's a good option for people who want a traditional way of investing in a non-traditional asset, right? If you could go own gold yourself, but you have to have a place to store it. You have to have somebody that you're going to buy it from that you trust. You have to have somebody that you're going to be able to sell it back to. And those things can be tricky. And Bitcoin, you have to have a digital wallet. You have to do all this other sort of stuff. So the ETF structure makes it easy. Of course, Bitcoin or other cryptos, high risk investments, short trading history, no underlying cash flows that support the value. Like Bitcoin is worth what anybody will pay for it. That's why some people consider it an asset and some do not. I'm not going to get into that right now. That's not your question. I'm just going to say, do your due diligence. You should do that with any investment. You apparently have done it and have decided to invest. So now, when you start looking at spot or physical Bitcoin funds, you can't have a truly physical Bitcoin fund because Bitcoin is not a physical asset. Yes, expenses matter. You're going to be looking at somewhere around 0.2, maybe 0.25% on an expense ratio. Though I will point out the Van Eck Bitcoin Trust, which is ticker HODL, HODL, hold on for dear life, which is what some folks want to do with Bitcoin. is waiving its 0.2% expense ratio until January of next year, or until it reaches $2.5 billion in assets. It's at $1.5 billion or so now. So you could get a little bit better performance out of that because you're not going to pay the expense ratio. But functionally at that point, yes, they're basically the same. So whether you're buying Wisdom Trees or Invescos or Valkyries or Bitwise or Van Eck or what have you, and there's others, Fidelity, etc., you're looking at pretty much what's the expense ratio and how easily can I get it in whatever platform I'm using to buy my ETFs, or am I buying it direct? There is not a massive benefit to saying I'll buy the biggest, just as there's not necessarily a massive benefit to the buying the biggest gold fund. They might have a slight benefit when it comes to expenses, but they don't. It's literally hundredths of a percent from, hey, we've got better storage contracts or what have you when we're figuring out how to do this. So to me, yes, if you're going to do this and you want to make sure you've got it, make sure you're getting the cryptocurrency you want, or cryptocurrencies. If you're looking at Ethernet or something along those lines, if you want to add more than just Bitcoin, but don't go towards the structured products or what have you, unless you really understand them. Like the IBIT, the iShares Bitcoin Trust, is a straight up Bitcoin ETF, but the IBLC, the iShares Blockchain and Tech ETF, that's like owning the gold miners. If you're worried about losses, you could do something like what Calamos has done, where they have their structured protection funds, something like CBTA, the Calamos Bitcoin 80 series structured alt protection ETF. They are constantly reissuing those. So they come out. CBTA was the April version. It has downside protection. You can't lose more than, say, 20% of your investment during the outcome period. It depends on which one you're buying. And given that Bitcoin has seen drawdowns of 50% at times and what have you during times when crypto gets on the outs with the market, well, you could blunt your potential losses, but your gains are also capped, right? So the one that they just did that I mentioned, CBTA, you could only lose 20%. You could only make 51% of whatever Bitcoin makes. So if you're buying it because you want it to be a go-go piece of the portfolio, that's not what you want to do if you're looking to have something to make sure that you're protecting yourself against downside risk because you know that you might pull out. That would be a way to do it. But again, if all you want is spot Bitcoin, very simple, very straightforward. And the only other thing I would say to that is, yes, if you're adding allocations to crypto, as I would say with gold, those are cases where you want to make sure you are rebalancing on a fairly regular basis. In other words, because you can have a significant run, as much as it's really good to say, like, wow, gold has been up massively over the last 2 years. Let me, my 5% that I put into gold is now 10% of my portfolio. Let me keep that going because it's been so good. That's not really what you want to do. You're adding a strategic allocation because you want certain attributes and you want them for a certain piece of your portfolio. If the market rewards you, rebalance. And if the market punishes you, rebalance as well, putting more money in because you have it there for a reason. And that reason is not correlated with the rest of the market. So it's going to maybe zig when the market zags or what have you, and help you out in that regard. Al, thanks so much for the question. And if it is you and you used to live in Malden, let me know if we should be adding Texas Instruments to the ticker list for Quick and Dirty. But right now, we're going to take a quick break, and then we will be back with more of Money Life. We're talking tipping with Ted Rossman from Bankrate.com right after this message. Now let's take a look at what the survey said. Yes, this is the survey said on Money Life. It's where we dig into what people are doing, feeling, thinking, and happening around their money. Yeah, and today we are looking at the latest tipping culture survey from Bankrate.com. And, tips have been in the news for a lot of different reasons, whether or not they're still going to be taxed and other things. but they're also there because, quite honestly, Americans are more than a little upset when it comes to tipping behavior. And we've discussed it before. Every survey seems to show it, that the general feeling when you ask people about tipping is,
I'm as mad as hell, and I'm not going to take this anymore.
But they do take it. They just grumble about it. Here to discuss that grumbling and what it all means, Ted Rossman. He is Senior Industry Analyst at Bankrate.com. Find him on our guest page, and you will find a direct link. You'll also find it in our show notes to the Tipping Culture Survey. Ted Rossman, it's great to have you back on Money Life.
Thanks for having me.
I have a tip for you. If you want to talk to people and get anything positive, don't ask them about tipping, because generally this is like Americans hate it. And it's getting worse and worse, isn't it?
It is, yes. 63% of Americans have a negative view towards tipping. That's up 4 percentage points from last year. The most common complaints are that businesses should pay their employees better rather than relying so much on tips. 41% said that. Also, 41% said tipping culture has just gotten out of control. 38% are annoyed about those pre-entered tip screens that pop up at coffee shops and food trucks and elsewhere. There's a lot of grumbling to go around, as you said.
Well, the flip side of that one, though, and I wonder what would happen, because all of the things say, look, if you put those tip screens on, people tip more, which on the one hand makes sense. I wonder what would happen to tipping if those places took them off of there. Because let's face it, you got people who, even if they're not making their money on tips, they work the counter at some whatever, every little bit helps them. And what we'd see happening to tips, because of course nobody carries cash anymore. So it's not like you can go, oh, keep the change, and there's a lot of change. These are all people who are not doing it. So that's part of the problem too, isn't it?
Starbucks provides an interesting window into this. They unveiled tipping with credit and debit cards a few years ago, and you get prompted on the payment terminal or in the app. They say half of their customers are tipping in those instances. That has to be way more than the percentage that we're putting bills or coins in the old-fashioned tip jar. I've never seen a percentage on that. I'm not even sure how you could, unless you had somebody like with a pencil and a paper tracking, every customer. But suffice to say, I'm sure way more people are tipping digitally than used to be doing so in cash. That's part of what's emboldened more businesses to ask for these kind of tips at the point of sale. They embed it in the payment terminal or in the app. Some professions have actually lost out because of this shift away from cash. Like if you're a valet or a hotel bellhop or room attendant that, people don't have the cash, then you might actually lose out. But, I would say technology is enabling all the asks for tips. The other thing is inflation, which obviously has squeezed consumers, but it squeezed businesses too. And I think they're viewing tipping as a surcharge. It's a way to raise prices without raising prices. It's a way to funnel more money to their workers without having to foot the bill themselves. That's why so many of them have their hands out for customers to tip.
Is part of the problem also that we feel judged? Could we maybe find a happy medium where, okay, fine, I'm not going to stop tipping, but I'm going to be okay and not feel like somebody's judging me if I tipped a little less?
In my view, I think we need to separate places where tipping really should be customary, like where it's part of the social contract, versus where it's more optional. I would view a sit-down restaurant as probably the best example of where you should be tipping. Yet our survey found that only 70% of diners always leave a tip. That feels low. It's especially low for Gen Zers. They're the worst tippers for pretty much everything. Only 43% of Gen Zers always tip at a sit-down restaurant. That's remarkably low. But I think we should be tipping at restaurants, ideally 20%. We should tip for haircuts and food delivery and taxis and ride shares, although those categories, only about half of people always leave a tip. Those to me would be more universal. Where I think it's more optional would be the coffee shop or the food truck or something like that. I mean, maybe if you're a regular and they're really nice to you and you have a complicated order and they always anticipate what you want, I mean, maybe that's the sort of thing you tip for at least sometimes. Or if you have a really big order, maybe then you're more apt to tip for something like takeout or counter service. A big part of what's given tipping a bad name is the constant asks for tips. Like when I was asked for a tip at a self-checkout machine at Newark Airport, that was pretty crazy. Or the pick your own strawberry farm, or, some people say their doctor's offices are asking for tips. Like, that kind of stuff feels crazy, but I wouldn't take that out on the restaurant worker. They're dependent on tips. And the federal tipped minimum wage is $2.13 an hour. I actually think this no tax on tips push could have some unintended consequences. There's not much of a safety net to being a tipped worker. I would actually rather see that strengthened in terms of better retirement plans, health plans, paid time off. To me, that would be more meaningful because people aren't tipping as well. So even if it's not taxed, you might be in a precarious position there.
Yeah, I agree. We've talked about some of these examples in the past. I remember you telling me about the tip screen at the Pick Your Own Strawberries. The flip side of this is, as somebody who runs a small business, I run the Boston Box Lacrosse League. When we first got our ability to take credit cards, it automatically was set up to have a tip screen. Now, I'm not expecting anybody to tip me. You're paying a fee to play in the league. That's all it's going to do. And I would make it that you couldn't see that screen in terms of, it took me a while to figure out how to make it go away, but we would enter things. And before we'd hand it to the person to say, yes, click on it, we would have already said no tip. I think some of this is also that technology. And you know how we are. Like, everybody's like, oh, I've got my new phone. I'll start using it without reading the manual. I'll start doing whatever. And then you sort of see the unintended consequence of, well, somebody did tip, so I'll leave that there or whatever. I think some of that's also carelessness, don't you?
Yeah, I don't see it changing, though. I really don't think we're going back. I expect to see more tip prompts in the future, not less, because of technology, and also because businesses have really caught on that this is a way to get the customers to pay extra and subsidize employee wages without that business owner being the one on the hook to foot that bill. I really think we're going to see this creep into more and more industries and payment terminals, and people grumble about it, but I just don't see it really changing. Another thing is, we referenced the guilt tip, that maybe you didn't feel like you wanted to tip for that sandwich or coffee, but you did anyway. Maybe the perception that the worker's looking at what you're entering or the customer's in line behind you, that feeds into this as well. I mean, this concept does work. Even if people complain about it, it definitely raises more money for the workers, and they like it. And in turn, their bosses like it because they don't have to be the ones paying it.
Yeah. And at the same time, if you're one of those folks who's feeling the pinch and you're trying to do something for yourself, well, okay, tip what you can reasonably afford. Like, as much as they may judge you, they still need you as their customer. So barring the I'm leaving nothing when you should be leaving something or so along those lines, you're not likely to have an encounter that says, really, you only tip me 15% instead of 20. There are ways that we can make this better on ourselves if we're in that class. I don't go out enough to worry about tipping that much.
And some of this comes back to prioritizing. Like, some of this is especially relevant around the holidays, but if you can't afford to tip everybody, who really made a difference? I mean, maybe it was a babysitter, a housekeeper, a dog walker. Is there somebody in your life that really went out of their way to give you a better experience? That's another way to think about tipping. Or, if you had furniture delivered and you couldn't decide where you wanted that couch and you had the guys move it 4 times. I mean, maybe you're more apt to tip for that than for something that was more of a nameless, faceless kind of counter transaction. So we all need to figure out where to draw the line. But, one thing's for sure, I think we're going to be asked more about this in the future, not less.
Was there any place where the people in the survey kind of said, yeah, I like tipping here, I'm good with it?
We did see some stabilization this year. So we've seen a steady decline, really ever since 2021. There's been a steady decline in the percentage of people tipping pretty much everywhere. This year, that reversed a little bit. People are starting to tip a little bit better at restaurants and for food delivery, for taxis and ride shares. I still think there's a lot of room for improvement, but maybe we've at least found the near-term bottom. I would attribute this really to 2 things. One is inflation has eased, so people are feeling a little bit better about their purchasing power. We also view 2021 as kind of the recent peak of tipping, and that was because of the pandemic. People briefly kind of felt this groundswell of appreciation, and it's like, oh, we're going to tip better. That hasn't lasted, but at least the decline has stopped. So I think we've kind of found a new normal here for tipping. But we should be tipping at restaurants, and we should be tipping for haircuts and food delivery and taxis and ride shares. I would view those as the more universal, whereas some other stuff, like at the coffee shop or picking up takeout food, I would view that as more optional.
Lastly, one of the things that I thought was interesting is that the majority of Americans, according to your survey, say that they do have the amount that they tip influenced by the quality of the service. And that makes some sense too, that if somebody goes out of their way, as you said, you were talking about making sure that they were doing it, but just generally speaking, if the tip culture bothers you, but you need to do it, at least participate and do it as a way of encouraging the good service, right?
And that's one of the reasons why some people like tipping, and they say that it encourages better service, that people have to work for their tips and they have to satisfy their customers. I mean, hopefully people want to do a good job anyway. And if something goes wrong that's not the server's fault, hopefully you don't take it out on them. Like if you had a bad experience because of something in the kitchen or what have you. But, in general, this is one of the arguments for tipping, is that you want to reward a job well done. So that's going to encourage better service, hopefully. It doesn't always play out that way, but that is one of the arguments for it. But yeah, I don't think there's any turning back. I think the tip train has left the station. And, the fact that we were talking before about if you complain about it, are you going to take your business elsewhere? I mean, it's become harder to do that just because it's not like there's one coffee shop doing this. It's pretty much all of them at this point. So I do see that we're pretty far down this path.
Ted, great stuff as always. Thanks so much for joining me on the show. We'll talk to you again soon, I'm sure.
I'll look forward to it. Thank you.
That's Ted Rossman, Senior Industry Analyst at Bankrate.com. Check it out. Again, the direct link is in our show notes. If you want to go to the survey on tipping culture, it's great talk around the dinner table with your friends to see how they're doing and what they're feeling about it. And you know what else makes for great talk around the table? The other interviews we do on Money Life. Up next, Andy Wells from Sanjac Alpha. It's big interview time. Stick around.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
It's time for the big interview on the June 5th edition of Money Life. Joining me now, Andy Wells, Chief Investment Officer at Sanjac Alpha. It is a Houston-based investment management firm that focuses on actively managed fixed income ETFs. Really interesting the way that they do it. And when you talk about their ETFs, Sanjac Alpha Low Duration, SJLD, which is like a cash alternative, their Core Plus Bond Fund, SJCP. If you want to learn more about what they do and why they do it and how they kind of use their system to develop their tactical approach, go to Sanjac, SANJAC, sanjacalpha.com. Andy Wells, welcome back to Money Life.
So it's great to see you, Chuck, and great to be back with you today.
These are really interesting times for anybody who's on the fixed income side of things because, people tend to always focus on the stock market, and the stock market is giving one message right now, and the bond market is giving a very different message. And as I say all the time, when those two sides are disagreeing, if I had to bet on the winner's the bond market. The bond market's the one that tends to be telling the truth. So what is the truth that you are reading about markets now out of the bond market?
The bond market, as you say, is the ultimate arbiter in terms of risk of the economy. And I think what the bond market's telling us right now is that inflation is going to be here for quite some time. Interest rates, the 10-year I checked last couple of days were around 450 on the 10-year and around 5% on the 30-year. And we sort of see those as lofty, kind of negative for the stock market rates and actually kind of negative for the bond market if you've been holding them a while. But they're actually priced about where they should be because inflation is here. And if you take the adjusted rate, which is the kind of the real rates that we're seeing right now, it's around 2.5% real rates. So even if inflation is slightly decelerating, as we've seen in some of these reports, although they've been conflicting, I think that the bond market is telling us that inflation is here and we need to get comfortable with these rates because there's really not a good chance, at least for the rest of this year, that we're going to see those rates come down very much.
I happen to agree with you. I've actually said, I don't think we're getting a rate cut this year, but I know I am in the minority and I don't manage money. You do manage money. When you tell people you don't think a rate cut is coming, what is the reaction that you are getting?
You're absolutely right. Everyone wants a rate cut. The problem is the economy is in disagreement with that group. The economy is telling us, and this is just looking at these real indicators, like yesterday we saw the JOLTS report and everyone was very surprised that the jobs market actually looks kind of healthy. And that's because we had been looking at these PMIs and some of the soft data that had been coming out over the last couple of months, and we just were preparing ourselves for a really bad number. And of course, we've got the payrolls number coming up on Friday, and we had ADP today. ADP is kind of a terrible indicator on farms payroll. It always historically has been. So we really can't go by the fact that the ADP had kind of a good number, or at least not as negative as we thought. And so we see this as soft data said that the economy was kind of showing some cracks, and the real data keeps coming in and saying, no, actually, the economy is doing pretty well, and it's operating pretty efficiently at these rates. So that's kind of good news in the sense that these rates aren't showing themselves to be extremely restrictive. The stock market is certainly performing well. We had the V-shaped recovery. And so now I think we just kind of need to look at the rest of the year and develop our expectations about what we can expect to get from the markets.
I'm curious, especially because you look at the technicals and you kind of take a very quantitative approach to all of this, how you see the tariff situation and the possibility of a trade war with China, most specifically with China. In a trade war, the thing that we export more of than anything else in this country is our debt. And so there's a lot of buckshot that can be fired there. So I'm curious, how much are you gearing up for that to become a problem? What do you see happening from the China side of things that we're not talking about much here?
What we see there is China has been accumulating gold and divesting themselves of treasuries. Now, they've been doing that for some time, so this isn't something that's occurred simply because of the trade war. We think that China now views, and by the way, those are kind of the two world reserve holdings that people think about when they say, am I going to hold gold? Am I going to hold treasuries? Usually hold both. And what China has shown us is that they are going to divest of treasuries and buy more gold, and that's what they've been doing. And so that's not really a surprise. What I think you pointed out that's very, very relevant to the conversation is that rates globally, we have kind of this secular setup for an oversupply of treasuries in the market for several reasons. One, our foreign investors are tending to kind of divest of treasuries, at least not buying them as aggressively. I'm talking about Japan and the UK and some of the groups in Europe. They're just simply not buying them as aggressively as they were in the past. We have the Fed, who's certainly not buying treasuries right now. And finally, then you just kind of have the real market to rely. When that's all to rely on, and we have to refinance all of this debt, which is what Scott Bessent keeps talking about. We have to get our debt termed out to longer term. We need to get some of these T-bills and stop rolling those over every 90 days and get this out refinanced out to 3, 5, 7 years. That's going to mean that we're going to have to put supplies of treasury onto the market. Now, it's exacerbated by large fiscal deficits, which again, those types of things can really, really exacerbate an already existing problem. So to take your question and divide it into two parts, we have a secular setup that say that there's going to be more supply of treasuries on the market and probably less buyers. Means long-term treasuries, at least, appear to be slated to drift up from here. We don't necessarily think there's going to be any sort of calamity from this because the cure for higher rates is usually higher rates. And at some point, they become so attractive that someone says, hey, I'll buy a 6% treasury because what can I expect right now in some of these other markets? I mean, 6% sounds pretty good. So we don't think that's necessarily the case, but we do believe that that's going to prohibit treasury rates at least 5 years and out from coming down. Now we see the 2-year and in a little bit differently because that's closer to what the Fed can control. So if the Fed does make a move, they can actually control the 2 years and in a little bit more by doing things like cutting rates or even signaling things like possibly buying bonds in the future, things like that. And as we pick up those expectations, that could pick it up. So what that really means is a giant steepener in the market, which means, and we've already seen some of it, term premium is back in vogue. So we have 70 or so basis points of term premium, and then we have this market that shows itself to be 10 years seems to be, and 30 years seems to be showing a weakness, and yet the 2-year and then stays pretty stable. And by the way, that's a pretty good yield. You're getting at the 2-year level almost 4% to be able to hold something that is not ultimately that risky, because again, you're only holding it for 2 years. And by the time you've held it for a little while, it becomes a 1 year and then it becomes a 90 days. So those types of assets we actually like. And the long-term stuff, we're really steering clear of long duration or long dated bonds right now.
Which seems to be the obvious play. But I'm curious because we had a guest on the show a day ago who was talking about how, on the one hand, yes, he would be avoiding them. And on the other hand, they are the key indicator he's watching to see if the bond market is telling us the truth. You look at it that way too?
I do. I think that the bond market, again, always tells the truth. We can be deceived by lots of momentum plays, lots of different markets out there tell us lots of short-term things. But I think the bond market does tell the truth. And what it's telling us is that we have inflation, and we're now in an inflationary environment. And everyone kind of, including me, would love to return to 2019 and say inflation is going to be 2% or below forever. And we can exist in that market, and all markets get to go up. Bonds are great, stocks are great, everything's great. The problem is we're now in a market that is in a secular inflation looking market. And so when you have that, you typically see stocks and bonds both struggle kind of together when you're in that tough environment. But also you can see some real whippiness in the market, meaning that you could have a secular bear bond market, but then you have a cyclical bull, which means, you can have these short-term swings that make yourself kind of feel comfortable that bonds have rallied back 30 basis points, which was a big move, and everyone thinks we're back on the 2019 and in train, but we're not. We're in a new world, and we just need to become more comfortable with these rates. So to your guest's point, if you're comfortable with that longer-term bonds, the way to play that is to average in, because you average in with constantly higher rates, you're going to do fine because you're constantly keeping yourself invested at lower prices. And then when the duration rally does come, you can possibly take profits there. So that would be a way to play that market. That's not necessarily the way we're investing it. We're investing, again, for the shorter term simply because there's so much yield there. It's kind of crazy not to.
Let's talk about what you see happening in Washington, because you've mentioned what future deficits could mean. But how worried are you? I mean, how much are you looking at this going, hey, if we add enough, there comes a point that I will look at things differently. And by the way, in that question, let's point out that, what everybody stopped talking about now after a few brief weeks of talking about it was that last credit downgrade, where finally they've all downgraded us. So having lived through that and seen that that was kind of a nothing burger, when you look now, are you looking at Washington going, guys, do you understand what the impacts are going to be? Or are you thinking it's Washington, they don't understand anything?
Well, these rating companies, we took the approach that the Moody's downgrade was not real. It was, as you pointed out, it's kind of a non-event because you've already been downgraded by the other two. Now you get downgraded by the third one. It kind of loses its effect after the first and second one. And so we weren't really moved by that. However, we were perfectly happy to agree with them that large fiscal deficits are very, very bearish for the economy as a whole, both medium and long term. And what's crazy about this particular look of the economy right now is you have low employment, yet you have these large fiscal deficits. And typically those move in the opposite direction. So the divergence occurred a couple of years ago. We started seeing, hey, employment actually is tightened up and almost full employment. Yet we're running these large fiscal deficits. And usually you see the opposite. When unemployment's high, you run high fiscal deficits and you try to remedy that. So in this case, we see adding more to the fiscal deficit. And right now, you're looking at something in the neighborhood of 7% of GDP. That's a big number to have full employment and to also have rates pretty high right now. And so in an inflationary environment. So I think what the government's going to have to grapple with here, we've all heard Scott Bessent's grand plan, which is we're going to grow our way out of this deficit problem. And we're going to continue to run large fiscal deficits. We're going to grow our way out of it. Well, that's going to be tough because as the fiscal deficits begin to eat away as a percentage of GDP, that tends to be very, very debilitating to GDP growth. And higher rates certainly don't help, but they aren't necessarily a hindrance if real rates are reasonable, which they are right now. So we see this as yeah, it's kind of a dangerous game. And I think it's really most dangerous for equities because equities are pricing in expectations. And we look at the Fed Fund futures market and it's pricing in 2 cuts by the end of this year and another couple of cuts next year, I think 4 by July. So the stock market's pricing that in. So in order to uphold these valuations we currently see today, we need 4 cuts by next July. That's something that I'm in agreement with you on. I don't think we're going to get them. I think the rate cut cycle ended at the end of 24, and we need to become comfortable that the Fed is going to be hands off from here on out. And in fact, to throw a real wrench into things, I think the Fed could consider waiving rates at some point early next year if we continue to see inflation be this persistent and act as a debilitating element to the baskets of stocks that we're all holding, and that in conjunction with tariffs. And tariffs, again, I know the camp, and I've heard their argument on why tariffs aren't really inflationary. I've heard the arguments, but I think that Occam's razor here needs to be applied, and we need to look at when incoming goods cost more that they're being imported. And these small cap companies that we all buy in the Russell 2000, they may build things here, have their operations here, but their raw goods come from overseas. That's a tariff and that's inflation that has to show up in prices. And trueflation, some of the immediate trueflation numbers are reflecting that. Prices are going up. They're not actually going down.
In that answer, you brought up equities, and I may be a little bit remiss because as we started this interview, I positioned you guys as fixed income managers, and that's where you tilt and you lean, but you look at the entire picture. So I haven't asked for your take on the stock market for the rest of the year, at least. And I know you've got one, but let's cut to the chase. Are we going to wind up seeing it hold what we've had as a rebound, or does it have room to grow? And if it's growing, where is it growing? Is this more of a couple of stocks at the top, or is this something down the pipe, a little more of a stock picker's market and not quite so obvious that it's a few things carrying the water?
The luxury we have is we've been able to see some little mini cycles through the first half of this year. We've seen what happens when you go full bore tariff. We've seen what happens when you take them all off at once. We've seen what happens when you postpone them. So we have some little trial balloons that we've run into the economy to see what would happen under different circumstances. And it's interesting because I think what we should say is it's going to be more of the same. And I do think we can hold what we've got in terms of equity gains, albeit very, very slight. I think we could get as much as 5-6% out of the stock market this year, but it's going to be slow. And the problem is when I talk to my equity counterparts and they ask, when am I going to start making money again? That translates to when am I going to get 10, 20% out of the market again? And that's gone. I think that's what we really need to come to grips with. Stock market could be set up for several years of 5, 6, 7% gains, which should be perfectly fine in kind of a stagnated market, which we're kind of in right now. But I think everyone's expectations just need to be lowered significantly. And to divide that up a little bit for you, Chuck, I would say that the Mag 7 doesn't really care about higher rates that much because they've got huge balance sheets. They've got incredible profit margins. They've got lots of cash. They don't need to borrow as heavily as some of these others who survive on borrowing. So I think there's still a good play, a good case to be made that the Mag 7 is going to lead the way and probably outperform equal weight. The thing I think you would do to conditionalize that is say, if we have a kind of a complete calming of the markets and everything just sort of calms down and tariffs, trade agreements get done and that sort of thing, I think equal weight could outperform. But if we're going to have all this tumultuous behavior, I think the best thing to do is sort of set up your Mag 7, have some exposure to equal weight, maybe a very small exposure to small caps who are very, very susceptible to rates and inflation. And I think you just kind of do it in that order. We do kind of like the Mag 7. We look at this, of course, from the standpoint, as you pointed out, of credit analysts. So we are looking at the credit spreads, which are now back to normal, essentially, after all this crazy widening and all that we saw in the first part of the year. So that tells us the stock market's probably okay. We're not going to have a huge correction, but we definitely aren't planning on any sort of large double-digit gains this year.
And domestic versus international? International's been leading the way. Does that hold for the rest of the year?
If you could go back in time to January, we would all say international. Absolutely. International has kind of gotten what it's going to get out of this play, I believe, because it's now priced in the uncertainty, it's priced in everything, but it's also picked up the short-term gains that a lot of these countries by repositioning have achieved. So we're back to kind of US is still where we would invest. Again, we like the really tight credit spreads that are just indicating to us that there's really no major problem right now in the equities market. It doesn't mean it won't weaken in the future, and we may have a different conversation first part of next year. We think for the remainder of this year, companies are generally pretty healthy. Earnings look okay, if not kind of better than expected. And so if that holds up, then US is still an area that could possibly outperform overseas through the end of the year, but we would at least put that a little better than 50-50.
Andy, I really appreciate the time. Love the fact that we got a ton of stuff covered in this one, but I'm already looking forward to the next conversation as we watch how it plays out. Thanks so much for joining me on Money Life.
Thanks so much, Chuck. Honored to be here.
That's Andy Wells. He is Chief Investment Officer at Sanjac Alpha. Sanjac, S-A-N-J-A-C, sanjacalpha.com. I spelled it so you can find them if you want to get more information on the firm, on their ETFs, and more. And speaking of more, well, there's not much more to today's edition of Money Life, but let's cross the finish line together. I'll set you up for tomorrow before we finish up today. We're back to wrap this one up. I hope you caught near the end there what I was telling you about in terms of Andy Wells saying he thinks international has played out. You had Brad Lammensdorf saying the opposite of that. You had Alan McKnight earlier this week saying the same as that. You had Todd Rosenbluth pushing towards an international ETF. In that, Todd made fun of, the guys was wrong earlier this year, which Alan wasn't. Alan had entered the year expecting international to do well. It's not a zero-sum game. Like, this is where you're trying to figure out what you want to do, and you could make both cases. It's which side are you going to believe? And when you see the pros have this kind of disagreement, well, remember, you are in the middle of those disagreements.
I don't know what you're trying to prove, but you're proving it. You're proving it.
That's kind of what I am trying to prove, is that you are in the middle of disagreements, and disagreement make a market. So if you're going to lean into international, it may be because of the portfolio construction reasons. It may be because you want more exposure to something that is less correlated to the U.S., or it might be because you think that's the best investment case. Or the flip side of that is you don't want the international exposure. You like being in the best market in the world still, and you don't want to deal with non-SEC and hedging things. Remember, I'm asking hedging questions coming. So if you've got questions on hedging currencies, which I've gotten one or two of, yes, get me those. Chuck at moneylifeshow.com. But that's important. Tomorrow on this show, Michael Grant from Calamos will be here. Willie Delwich will be here talking technicals. And Eric Lutton from Sound Income Strategies makes his debut in the market call, talking income like BDCs and REITs and income ETFs. So that should be an interesting one. Meanwhile, if you are looking for something to celebrate, it is the Festival of Popular Delusions.
I don't know where you get your delusions, laser brain.
Popular delusions? I don't know. And festival, well, we're not invited to it. It's just supposed to be a day to celebrate popular delusions.
You are delusional.
Well, before you take that attitude about somebody, remember, it is National Attitude Day as well.
Whoa, attitude.
Yeah, in this case, it's supposed to be positive attitudes. It's also National Start Over Day.
Cut, sorry. Try this again.
Okay, it's also National Start Over Day. And then on the food front, it is National Veggie Burger Day.
Cheeseburger in paradise.
It's not a cheeseburger. It's a veggie burger.
Oh, this stuff is terrible.
By the way, if you want to make it better, it's National Ketchup Day. And I've started making my own. If you want my recipe, I will give it to you. It's also National Gingerbread Day. And if you want to get the taste of the veggie burger out of your mouth, well, it's National Moonshine Day.
Fat, drunk, and stupid is no way to go through life.
Yeah. I've had a sip or two of moonshine.
Oh, this stuff is terrible.
Yeah, I'd probably rather eat a veggie burger. My guests today were Todd Rosenbluth, head of research at Vetify. It's vetify.com. Ted Rossman, senior industry analyst at bankrate.com. And Andy Wells, chief investment officer at Sanjac Alpha, sanjacalpha.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. He was very well behaved yesterday. But mostly thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from Francis Burney, who said, "Money is the source of the greatest vice, and that nation which is most rich is most wicked." Well, I'm not going to get into the idea of who's wicked when it comes to their money. I'm just going to get to the idea that you keep money in its proper perspective. And that means remembering that until we do this again the next time, best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
We are officially over.